Hello, everyone. Steve Ankerstar here. Thank you so much for listening in and welcome to our first quarter of 2024 Investment Advisory Board. And again, the purpose of this meeting is to not only talk about where we were in the past, the past fourth quarter of 2023, tell you how we did and why we did what we did, as well as what we're doing going forward and why, to kind of get out in front of your questions there so you can feel comfortable with how your money is invested. There are the members of the excuse me. I also have a small cough. I'll try not to cough through it, but cedar fever here in Central Texas. They're the members of the team. There's one new name up there, Mike Youngman, as our Chief Investment Officer. He started yesterday. So we're very pleased to have him on board with his insight. He did work on some of the materials that we prepared for the briefing today, and I thank him for that. As far as the what this show is going to look like going forward, is it'll be more like the earnings call, that where the CEO kind of kick things off, kind of give the big few minutes of strategic map sort of insight, and then it would go to the CIO for reviewing the investment material. But we're not there, obviously, after a day. So next quarter you'll hear a different voice up here. All right, let's get going. Standard disclaimer applies. This is largely the forecast of the board. All the numbers you see up here, the predictions, well, the performance is accurate, but the predictions going forward are all our best strategies to get you, all the investor, into the best investments in accordance with your risk tolerance, or package them correctly in accordance with your risk tolerance. So standard, we don't all hit home runs. So therefore there are some that go the opposite way. We'll either stick with them if the thesis is true, or position out, sell them and move on if it's not. But investments can and do lose money. So there is the standard disclaimer. Okay, standard growth and returns. Very pleased to report it's a fantastic team effort in quarter four to be up. You can see not the big thing flashing at you. That's the annual. I'll get to that in a second. Quarter four was 12.8%. If you look at the upper left there in this area right here, see that 12.8%. And then across the year, which is the big square in the middle, thanks to the team member that made that for us here, the graphic for us. We are now over 76 million. You can see 78 up in the left. We're at the end of the year at 76 million, up 45% in all of 2023. So very proud of that. It takes a lot of effort for not only on our side, but also for all of you that send us referrals, right? So we do a lot of good work. We're very proud of our work. We're confident in our work, and the returns show it. However, the best thing you can do for us is, if you know of people that are in your situation that could use some guidance, then mention us and we can get them on board. We'd love to help them out. So to break down this slide a little bit, it was a good fourth quarter. On the left here is the 69 million or so that we started with the quarter. And then off to the right, you can see we put in 6.5 million of net gain from the market. So just that math tells you it's about 10% of market gain. And then we also had in the upper right a net 2.3 million come in the door. So the smaller numbers kind of break it down. You've got the 4.41 million, that's money coming in, 2.13 million money going out. You ask, what is that? Well, that's people buying houses and taking distributions, required minimum distribution. All that little stuff adds up to a pretty big number. And then 34,000 of income being generated through some different things out there. However, so that is the net of 2.31 of new money. The rest was market return. So super thrilled about that. Okay, for the specific book overview out there, AUM, which are the assets we directly manage with Schwab, is 81.06%. I'm in the lower left-hand portion of the slide. AUA is things like 401k, thrift saving plans, things that we can't necessarily hold directly through Schwab, but we can still manage. And, we'll talk more about 401k stuff in a little bit. Alternatives are your private equity, venture capital, all that kind of stuff you see to the right side of the screen. That's only about 5% of our book, but I will tell you that that's growing as wealth builds. There's a time when you should diversify away from the secondary markets, which have the standard stock market of stocks and bonds that goes through all the pain of herd mentality, right? Negative news and stock market sells off. Well, you get over into private equity and venture capital, alternative stuff. That stuff isn't affected by the news cycle. It's professional investing at the higher level. It's how the institutions do it. So we do have exposure to that. That's growing. And of course, a lot of things we have generate some cash. So we always have a good percent plus of cash on hand waiting for opportunities. As far as the standard investments out there, 213 individual stocks. We prefer about 50 individual stocks. The rest of the stuff kind of comes to us, whether it's somebody's, maybe we inherited it, they've held it for a long time, can't really sell it because of capital gains, that sort of thing. So our core of expertise is about 50 stocks. And then the rest of that 163, if my math's right, is kind of a core competence. Keep an eye on it, but it doesn't drive returns, if you will. 93 exchange traded funds. Again, we like about 10 I would say that's probably unfair, 15 or so that we really are our bread and butter, if you will. The rest are kind of, like I said, inherited stuff or some thematic stuff that folks are interested in. Mutual funds, we try to diversify away from those and find ETFs, which are the same thing but cheaper when we can. Sometimes there's capital gains that locks us into those. So it is what it is. Just know you're paying a little bit more. And if it's a taxable mutual fund, which it likely is, then of course you get the end of year distribution, which you may have just faced, where there's your tax planning for mutual fund owners. Tax planning starts about on December 29th, right? That's just how it works every year, but it is what it is. 224 bonds and CDs. We really amped up this year in certificates of deposit. It kind of peaked out around 7.7%. I'll show you the interest rate charts here in a second. And now you can't say 7.7, scratch that. 5.7%. I would be thrilled if I got a 7.7% CD, but 5.7% is where it kind of peaked out. Now we're around that 5.1% or so, and it's probably dropping from here. And we do have a couple options out there. Alternative investments, not going to cover in this brief. It's something that if you're interested in learning more about, we need to schedule another briefing to talk about that. Okay, how do we do and what we got right? Well, everybody likes to look at returns, so just go right to the far right side of the page there. So up top is what the overall market did. So Dow Jones up 13%, S&P 500 24, NASDAQ a whopping 42%, and a 60-40 portfolio. That's kind of that benchmark. Most of it, like I'm 54 or something like that. Up around my age, you're supposed to be, your age in bonds or something like that. So that's again, 60% equities, 40%. That generated a 17% return. So when you think historically, excuse me, markets, deliver a 10 to 12% return. That's why you participate in them. The more risk you take, the more money you can make. However, the higher the volatility, which the analogy I use is you walk into the amusement park, and if you look at the biggest, baddest roller coaster and say, that's for me, hop on board to high risk. If you're looking at other roller coasters and you're going, yeah, I don't want part of that over there. This is the one that suits me. That's how you assess that risk tolerance and invest accordingly. But what we got right at the top, no recession. So don't want to deliver a full history lesson here, but some look back is useful in understanding the context. And this is bragging about Ankerstar Wealth and why you should be happy that you have your money with us and tell all your friends, is because headlines can kind of carry the day. A lot of people flip on CNBC and you're getting today's trash, right? And remember, if there is no news, literally if nothing happens for a day, a news channel has to report news for 24 hours a day. So how do they get that? They just take everything to the extreme. It's overstating it a little bit, but just realize that's what you're getting. So let's do a little history lesson. 2020, we had COVID. The world was ending. The great wealth transfer. People say life isn't fair. Well, yeah, it is if you understand things, but if you don't, then the market crashes. People wait for it to crash. They sell their stocks. They basically hand them from the not rich crowd to the rich crowd who's buying when things are on sale, and then it appreciates completely through the end of 2020 into 2021. So remember, you don't go out and buy your Christmas sweater when they run an ad saying Christmas sweaters are at all-time highs. Come and get some, right? You buy them when they're on their discount. Very hard to do, but that's what professional investors do. So when people say, okay, well, the world is a, haves and have-nots, well, a lot of it's because people step into investing, they take a punch to the face, sell all their stuff at fire sale prices and never return, right? And it's tough for you to build wealth if that's your, if that's your experience. So don't do it. Just remember that happened though. And remember, we stayed invested and we stayed aggressive. And I did have the lock and load video on March 25th of 2020. Literally, we'll probably, if somebody were to do a look back on my life, my greatest call was, it was lock and load. It was time to go. I was 1 day early. Whoops, whatever. I'll take that. And that's where that was the market low, and it screamed higher from there. Same sort of thing as you go from 20 and 21, we're up. All the money we printed in 2020 and then kind of set mailbox money out. That came home to roost with some inflation in 2021. The Fed was, in retrospect, they were calling it transitory. It was not. I think First Trust says we printed like 36% of the total money supply in 2020, which, okay, yeah, we're going to have inflation. So not to get political, but just it is, right? You print money, no matter who does it, put it out there, things are going to be more expensive. So a little bit late with the Fed to come in with the rate cuts. So 2021 was still, hey, it's transitory. Who cares? Market goes higher. 2022 was a hunker down, take risk and dial it down, reposition portfolios for the rate hikes, which we knew were coming. And it turned out to be 10 rate hikes and about 5% increase in the overall, risk-free rate, the 2-year. That's where the Fed controls it. So, and then we got into, so in 2022, it was like, okay, that's a headwind, but CDs are starting to pay stuff. So it was a shift a lot into the short-term fixed income was paying a lot. If you look at the right, BSV and USFR, short-term instruments to capture that yield of the short term there, but it was kind of load up on shorter term stuff because rates are going higher. Then you get to 2023, and literally, and I don't want to be too hard on mainstream media, but you're not getting an unbalanced view. I don't, and especially if somebody's saying this is a balanced view. Everybody was predicting the mother of all recessions, or some recession at the beginning of the year, if not a bad one. And very few of us were out there saying, no, I don't think so. So here's why. There were two nevers that's going to, and I know many of you have heard me talk about the two nevers, but bear with me yet one more time, is when we have rate hikes that of 10 in a row, raise 5% and inverts the yield curve, that's an indicator. It's an indicator of a recession. And we've never raised hikes that fast and not had a recession. So that's one never. So that predictor means 100% we will have a recession. Well, another predictor out there is we've never had a recession with full employment, arguably 4% unemployment or less, right? So you have, so what are the forces that are out there operating in the economy? Are you have 96% plus of the people who want work, right? That's what that measures, who want to work, are able to work, and for whatever reasons, provide for the family or get rich or whatever, but you have this workforce component that is there and hitting on all cylinders. And then you have these interest rates, which is supposed to slow things down. And, there was some damage along the way, but for the most part, not really. So why didn't we have that recession? Well, it's because the workforce won out. And, some investing is literally looking around you. And, Warren Buffett talks about this, but I only have my experience with my family here in Central Texas, but when I go to restaurants, even when we travel, we go to restaurants. Restaurants aren't at capacity, not because there's not people, there's a line of people to get in there. It's because they don't have the serving staff. So that tells me everybody is working who can work, right? And then we're trying to use technology to get past that issue. Like Toast is a company that specializes in exactly that. It's kind of like the self-serve lanes at Walmart that helped them cut down on folks. The same thing, self-order system, and it's genius. But the power of the workforce, or people losing their jobs and then going out and creating their, then creating their own, grows the economy. So that's what won out. And we did predict that. And I kept saying, I don't think we're going to have a recession when everybody else was talking about that. And, part of that's luck. We could have had one towards the end of the year, but we really didn't. And look where we are now. The one thing that's kind of in trouble now, not in trouble yet, is housing, right? Because interest rates went up, the mortgage rates went up to about 8%, came back down. They're sitting around 7%, just below on the 30-year right now. And that's, people are saying that's the end of the world and the housing market's going to crash, but I don't know. The people in the room that are my age or older, it's like 7% was a heck of a steal on I happily signed that paperwork when I bought my first home, right? So we'll talk more about that in a second. So returns are there. There's our top 10 holdings. Individual stocks are our bread and butter. That is at the bottom. There's 4 individual stocks that are over there and 1 thematic ETF that really took off this year. Cybersecurity at the bottom, and duh, of course, money is going into cybersecurity. But Apple's our number 1 holding, up 42% last year, on par with the NASDAQ. Amazon 77, Google 58. So you basically have your why are we investing in this? Number 1 tech company in the world. Anybody can argue that, of course. But, most people, when they sell their Apple, regret it later, right? So even though Apple's been down the past 2 days, we've had some selling, people are already like, oh, it's over for Apple. And then pretty soon I'll say like, oh, so name a better tech company. And they're like, well, Apple is number 1. I'm like, yeah, I know. So stop selling your shares. Amazon, you got your number 1 logistics company literally in the world. Google, your number 1 advertiser in the world. Again, they provide information, but they make their money through advertising, right? And people paying to the top of the list. And then MSTR and Bitcoin. I don't want to go in this too much because it's its own show, but we do have exposure to Bitcoin. So separate in your mind cryptocurrency from Bitcoin. I fully believe cryptocurrencies are trash and gambling, and they'll die off. They're the pet rocks. They'll go away. Maybe stick around for fun. I don't know. Bitcoin is different for several reasons. And there's a bunch of catalysts right now that are pointing towards Bitcoin going higher. All I want to talk to is if you are listening to the ads on CNBC, or if you've been of the mind in the past where the US government is not very good at controlling its spending, check, and not very good at being fiscally responsible, check. So there's a slight difference there because they can print their own money. So we kind of saw that in 2020. We don't know what's going to happen going forward. We do have an election coming up, obviously, and for some reason, I think we're running it back the same 2 people. That is mind-boggling or scary, depending on how your political views, not getting into it here. But I will tell you that either side could potentially manipulate the money so much so that we break the dollar. And I don't think it's going to happen. And I'm not trying to be alarmist or a conspiracy person. I'm just saying it's potential. And if something has the potential, then we want a little bit of a hedge against it. So I'll conclude the conversation with this, and then we'll move on. But I will say, if you do believe it's a world of have and have nots, and it's unfair that the rich are too rich and the poor are too poor, if we elected the people into office that agreed with that and wanted to do something, the only way they can take action is to mess with the monetary component, right? Inflate the dollar. If somebody has 0, they still have 0. If I had 2 million, now I have 1 million, right? Of buy purchasing power, right? Countries have done this. Governments have blown it in the past. And I would like to think that would never happen. 10 years ago, I would have said never, and I would have stood on the mountaintops and screamed it. Now, I don't believe that. I don't think it's just because I'm getting older. I'm not saying get off my lawn yet. But I do think there's something there. There's a risk there. And a lot of people believe this, and a lot of people that I really respect in the investing industry believe this too. So yeah, MicroStrategy is our proxy holding for Bitcoin. It was up 345%. I put an asterisk. Yes, I was late. I only got about 100% of that for us. So, better late than never. And I still got 100% in the past 6 weeks. But we just switched to, if you notice, your MSTR is gone, except for a couple of people that have a lot of it that don't want to sell for tax purposes. But moving over to GBTC, which is the Bitcoin Trust. That's going to become an ETF. That's my prediction. That's one of the catalysts for it going higher, is that we are going to have a spot price ETF out there. Same ticker, everything. Big fee goes away to a normal fee, and you hold Bitcoin direct. So between I would say that's our number 1 upside out there is Bitcoin as we go into the election and several other events that are going on that makes it more attractive. And it's used worldwide. They have 2 countries out of our 200 plus countries in the world already have it as their official currency. Before I would have said, can't happen. This past year, I've thought about it a lot. I've read widely about it, and I could see countries going to Bitcoin. I really could, as their official currency. And I know it's got this big spot price, but you can transact in Satoshis, which are 1/1,000,000th of a Bitcoin, blah, 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 more later. And then we had cyber down at the bottom. The other stuff is in there intentionally, and that's generally a hedge to reduce risk or produce a lot of income. And they still did pretty well, but obviously when the market's going up, the big name heavy hitters are screaming higher. and the hedges and the income producers are going to be left behind. 2020, it was the reverse, right? Where, big stock, big tech is in the red and the other things are protecting your money. So it's a balance. So that's why we have both of them in there. Unless you are super conservative or super aggressive, you might be on one way or the other, but most of you are honestly in between. Okay, moving on to fixed incomes. I get this a lot, and I just have to say, tell all your friends, right? Is like, well, Steve, you handle investing money and my bank handles my bank money. And I'm like, well, your bank thanks you for that very much because they make a whole lot on your money. We charge a fee. We charge a fee that is very reasonable. It's lower than the industry standard, and I'm very proud of our fee. We'll more than earn that fee. Trust me. But when you go to your bank and you look for a CD, they're going to give you a CD after they've taken their cut. So it feels like you're not paying anything. It's kind of like your money that's in the bank that's just sitting there. Well, the bank is making a whole bunch of money on it. You're getting paid a little bit. It doesn't feel like you're paying a fee. You are. You're paying that opportunity cost between what your money could earn. So anyhow, I'll leave you with this. I'll say, excuse me. I can beat your bank. I've never been called out on it. I've never been proven wrong on that. Is I can beat your bank after my fee, except for teaser rates. And if somebody's going to give you some stupid rate for 6 months, go have fun with that. But call me in 6 months when that runs out. But a regular rate right now, this is today's chart. You can see up here from this morning when I last updated the slide. These are CDs. There's a difference between non-callable and callable. Most of your banks are going to be down here in the callables. We can get you more. Talk to your advisor and say, if you have over 25,000 sitting in your bank, I would just put the rest in here because you're going to get higher. These went up to that 5.7%, not 7.7, but 5.7 out the 9-month, 1 year, 2 year, and maybe not 2 year. I think 18-month was the most we were able to lock that in. But these update every day. Schwab doesn't make money on this. They provide it as a service. So they don't take that cut, right, that the bank does. So you get the full benefit of that, which is generally a point or percent and a half higher, and then subtract out our fee because we're not working for free, of course. But we can put you in these and we can buy and sell them so you're not actually locked in them. You accrue interest every day you hold them. So it's really pretty neat. And we use these callable ones that you can see the difference between the two interest rates is, 0.2, 0.4, 0.4, 0.8 out here. I'm not putting you in a 3-year city. That's personal preference. But yeah, for short-term money that you're holding to buy your next house or you just want to keep safe, this is better than your bank can give you. Okay. The other thing of interest here is the yield curve, which we get more into initially, but it's inverted because the short-term stuff is paying more than the long-term. Mentally that wouldn't make sense, right? If I give my money to someone else for the longer term, I would make more. We're inverted. That's why this is just not a good state to be in, but pretty much everything's clipping along. Municipals, I get asked about this on occasion. If you look down here, municipals don't pay a whole lot, but they're tax-free. They're tax-free at the federal level, generally tax-free at the state level. It's this across here. We're only going to do AAA. We don't need anything below perfect. But they do the math for you. Down here, this is the equivalent. And it says if you're in the 35% tax bracket, okay, good problem to have. Not many of you are, but there are a few. You're getting some pretty amazing yields in municipal bonds. It's only right for taxable accounts, of course, because otherwise you're just getting this return and might as well go a CD at that point. But anyhow, it's something to talk with your advisor about. It's really pretty attractive right now. You are investing in municipalities, but they spread it out pretty good. So yes, there's some little municipalities that could go upside down, but yeah, overall something to be take a look at. Okay. Will the Fed cut rates in 2024? I just want to show you, this is the 10-year. So think, this is kind of what drives that longer term rate. Almost the 30-year rate is kind of based, 30-year mortgage is based off kind of the 10-year. It's that tweener of a short-term rate. And of course, nobody knows what's happened 30 years out. So that's why most of your mortgages follow the 10-year and then add about 3 on top of that. So all the people involved can make money for the services they're providing. So earned money. I'm not begrudging them because they earn it. But this is a 3-month chart. So we were up at 5% on the 10-year and we dropped literally to 4%. So it's a 20% haircut. That's why over here we were seeing that 8% mortgage not too long ago. And then now we're seeing that 7% mortgage. So if if you're bored and want to follow along and play the mortgage game, this is the chart that you want, is the short-term 10-year chart. If you back it out though and look at the 1-year chart, you can see this is 2020. We raised the rates in here. It didn't really take effect until it went screaming higher. This mountain right here, had it stayed up, that is a huge problem for the housing market. If it stays here, it's not, it's back down here. So I'm not all that worried about it. But if you look at the 30-year, it's like, oh, come on. This is the participation trophy crowd that's crying about a 7% mortgage, right? Because if you're, I don't know, 40 or younger, you've never heard, it's an atrocity. Well, it's not an atrocity. It's a lot of what most of us grew up with. So I don't think it's that bad. So it really comes down to, that's why I don't think we're going to have a recession. And if we do, it's going to be pretty mild. It'll be because the housing market does start to hurt a little bit, if you will. But so far, so good. It's kind of magical how this had worked out. So let me get back to the right slide. Will the Fed cut rates? This is all you hear about on CNBC. I swear these people don't have anything to talk about other than rate cuts. You're well ahead of yourself. So experts, yep. Okay, I should probably cross that out and say people on TV say yes. The Fed says we'll see. What does the Fed always say? We're data dependent, right? They released the minutes today. And yeah, if you want, it's kind of like looking at clouds. If you want to see the bunny rabbit, it's a bunny rabbit, and everybody else looks at it and go, what are you talking about? People are reading these minutes and going, oh yeah, they're clearly saying they're going to cut rates 2 or 3 times. And that's like the tagline running across the bottom. So I'm like, no way did they say that, right? I'm like, there's absolutely no way they said that. So I go read the darn things, I read the summary, and yeah, they didn't say that. They're data dependent, right? Why would they undo all the work they've done so fast if there's not a problem ahead? So, I say no. I'm an anomaly there. So the team says probably towards the end of the year, and you'll see that in some of the stuff we talk about in a second. I say no. And, I've been guilty of being a little bit too much of an optimist, but then again, I'm also right a lot in that category. So that's why it gives me conviction to do that. Bottom line, we'll see. Nobody's got a crystal ball. Run from anybody that says they do. All right. The forecast you've been waiting for. What are we doing with your money? And a little bit of roadmap stuff going forward. This is a fantastic piece. This went out today with your invite. This will be hanging on the website as soon as we get control over on the website. This is the go-to from Ankerstar Wealth document for if you can't remember what I said, or you're like, I don't really agree 100%. Hang your hat on this. This is from Joel, brilliant economist, lifelong investor. He can see a lot of things that are out there. He understands all this stuff. We can pause while you read that. Obviously, you're not going to read that; it's too small. But you can get it online there. And again, he does end with real estate, and it's almost a so far so good. Remain flat through 2024. So we'll see in a little bit about the elections at the end. So what we did is we took that, and then Mike and the team got together and kind of published this review. It's a little bit too long to go through. Some highlights, though, is, returns were great this year, but you know what? It was the Magnificent Seven. That means 493 of the stocks in the S&P 500 weren't just screaming higher, right? And some of them were hurting. So it does make a difference. If you sit in your 401k and buy the SPY, I had my neighbor walk by. He talks to me every now and then. He's always trying to get investment advice out of me for free, right? It's like, what are the hottest stocks? Okay. It's like, well, you'd really know if you signed on, but you just want it for free when you go check the mail, right? And he said, finally, my SPY recovered back to even this year. And I just kind of laughed, and I'm like, oh my goodness. Everybody else is above even a little bit, a lot of bit. So I just smiled and said, hey, good for you. And then went on about my day. But it really did make a difference. If you were not in some individual stocks here, you didn't get the big upside. The holding pattern going into 2024, pending official confirmation of the Fed's pause and rate hikes. They kind of confirmed that today, but you never know, right? So really, we just need to kind of stabilize here, and we'll see. And likelihood of recession is now reduced to 25%. I think if we have one, it's not going to be a huge one. It's not going to be a game changer. It will give the Fed a reason to reduce rates. I don't think they do it without a reason. And then you get the shift. into the rate cuts whenever that happens. Again, I'm a little bit optimistic more than everybody else out there or even the team. We'll see. This could easily happen. There's more people saying that than what I'm saying personally. Inflation pretty well under control. GDP looks good. You could get some stagflation going on, or excuse me, the market may stagnate, but it'll be fine. And then just I fully stand by this. Is even though we had a huge up year this year, returns that 20% per year are unlikely. Okay. If you thought we were in recession camp and stayed out of the market this year, you missed the big up year. And now when it gets to that traditional, 8 to 10 to 12%, it takes a long time to make up for all that you missed. So thanks for being with us and thanks for staying invested with us. And again, if you look at, we're already off a couple of percent this year, been selling off pretty hard. So it takes a while to climb out and get back to even just from the first 2 days. Here's my kind of summary. Again, this is personal to me, differs a little from the team, but not much. The selling you're seeing right now isn't that 2024 is going to end the world. It's not. The election may, but the stock market at the beginning of the year is not. Everything is fine. What you're seeing is a lot of selling. And I will tell you, I was in here with a lot of, accounts, including some of yours, is if I sold on December 20, whatever last day was, 29th, you would owe tax, and for a big gain like MSTR, you would owe taxes in like 3 months because you have to file your taxes. But if I wait 2 or 3 days until the new year, then I can sell and you don't owe taxes for 15 months. And I can look for opportunities to mitigate that tax bill, where if I do it right at the end of the year, I mean, it's done. It is what it is at that point. So anyhow, that's what you're seeing, I think. And, I'm a drop in the, or we, excuse me, are a drop in the ocean as far as the investment world. So if we're having that problem, everybody else is too, right? And you see that after a big run up of a nice year. I think the first half of 2024, is going to be good. There's going to be volatility going into elections. After the elections, this is kind of weird. Historically, the market goes higher. And you're like, wait, doesn't it depend on who's elected? It's like, no. And here's why. So, November, whatever the date is for the election, there's uncertainty going into the election and there's certainty coming out of the election. Okay, I have to put what quotes on that now since people challenge elections and stuff, but okay, all that aside, we have a winner declared, either at or shortly after that date, and we all kind of move on. Well, not everyone moves on anymore, but for the most, the investing world moves on because it becomes a series of knowns. You have unknowns pulling up before the election, and then those become knowns, whether you like them or not. It's just facts, right? And all of us in the investing world take all the available facts we can have and some probabilities and make our best judgment to align our investments to make the most money within your risk tolerance. So it's like a big math problem. So I don't care if you put it on a constraint on there. I'm just going to factor that in and move on. So that's why stability and knowns are a lot better. And that's why you see that market going higher. Fed will be data dependent as always. I think you can count on that. I don't think Powell wants his legacy ruined by cutting rates too soon and then putting us right back to where we were. Why? I can't fathom that. So by saying that, that's why when everybody's predicting, well, the market's pricing in rate cuts. Absolutely, the market's pricing in rate cuts. I don't know that Chairman Powell and his team are pricing those in, and they have the say. We have a slight recession if the Fed's late. I expect, the Fed's almost always late. They were late to tackle inflation, and I think they'll be late to come back out of it. But I think that pushes rate hikes into 2025. But the bottom in the green, the bottom part in the green is 100% is when the Fed starts cutting rates, it will trump, but that's not what I mean there. It will be stronger than any other market event, and the economy goes higher and the market goes higher. We've seen that historically, time over time. Money gets cheaper, businesses can expand, life is good, and the market goes significantly higher. All right, some fun stuff. For those of you who are on early, here's our new website. Super excited. There's, one of the things we try to put as much information as we can in your hands. As far as the resources, there's a tab here. This is a screenshot, so it's not live, but it has checklists, it has calculators. And there's all these things that, sometimes you're sitting around on a Saturday or Tuesday or whatever your thing is, and you're like, maybe I should calculate my income tax, or what's my life expectancy? I'm 70. What does that mean? What am I supposed to get from here? How much will I earn? Tax advantages of annuity. I'm not anti-annuity, but generally you can make better on your own, but whatever. All of these things. and more. There's a whole nother page of these. That's trying to put, again, our goal is to put the most information in your hand so you can do it yourself. And then after if you've tried, if you still, now you're armed with all the information, now you can come to us for that judgment, right? Of, okay, I've read this, but I still want to understand, what is this? How should I best position my investments from there? Okay. And also, in the interest of putting, money in your hand, if you start in the upper left-hand chart here, leading the way in client interactions. This is from our brochure. We are trying to take all of the communications and put it into your hands as efficiently as possible. So it's called operational efficiency. The folks that are helping us do that down here at the bottom, Paul and Nico DeMaio, we've partnered with Advisor Stack, who brought a lot of this technology to us. And just like we like best of breed investments, so we can get the most money, you have your money working the hardest for you. Same thing with our technology. We want to leverage technology to get most information into your hand. And then come to the bottom right. So what's coming? This is why, people ask, like, why'd you stop your daily updates? It's like, I love my daily updates. Who doesn't like, well, I like hearing myself talk, but we're going long-winded, but I like the 8 to 10 minutes a day, give you what's on my mind. I'm coming back to that, or we're coming back to that as a team. But we really spent this fourth quarter, while everything was going well and we were spot on with our investments, is to look internally and develop these efficiencies, right? And really think through it. So once we get the building, which is coming up, once we get more clients, which I think will happen very quickly, with the help of you guys, we've got this vertically integrated tech stack, and then we can go to this surge mode towards winter. So about a year out, when we get the building, we'll talk more about that in a second. But if you kind of come around this circle into the middle, that is what the whole goal of this. And I wouldn't say it's disruptive, because I don't like that stuff, but the industry has been traditionally to justify our fee, we want you to come in and talk to us once a quarter, and we'll show you how smart we are, and we'll show you how dumb you are, and trying to justify their fee, period. Now, it may be a little bit of a strong stance, but that's what got me into this business, is because I did not like that at all. First of all, stop telling me I'm dumb and that you guys know everything, right? So what we're trying to do is leverage both sides of it. Yes, we have professional expertise, and we do this all day, every day, so it's probably going to outpace yours, but we want you to have all the information in your hand. And that is a screenshot off the phone of Black Diamond and the presentation it's going to have to you. So when you're sitting there, instead of swiping over to Candy Crush or Mahjong or what, word search or whatever it is, you can actually see the app right there, click on it, and see what your return has been versus a traditional benchmark. Am I up or down money with my recent investments? What do Steve and the team have, the transactions that you're taking? Well, I don't, especially if you don't ever look, it's like, hey, let's just hit the transaction and see what's going in. And, you'll see that you have like 18 different dividends coming in each month, right? Your projected income, if you're in retirement and you're looking at income, this is the number, right? This fake couple, right? So Mrs. Nobody, but, they've got $1 million and it's kicking out 40,000. So they can withdraw 3,000 plus a month without touching their principal. So you're getting so much smarter because it's right there. And then of course, Money Guide Pros are financial planning software. They're at 99% because everything's happy. If you're not, though, that also kind of incentivizes you to get this in the green, right? So really super excited about all this. I do think it's different from what anybody's doing, and I do think you should tell your friends. All right, here's the building kind of update. Here's me being silly, pardon me, there, but that's little kids excited every now and then, even though I'm older. This is the front left corner of the building, so it's right here. Looking backwards, super excited. 3,500 square feet. The middle part is Ankerstar Wealth. Here's where you're going to come in. We'll have a reception area, have our executive lounge, the war room. Here's the off to the right. You can kind of see what that looks like, and then the command center where we have all the machines and stuff. To the left and right, that's going to be, if I can make it happen, and again, I'll do my best, is to get a CPA firm, a 2 or 3, 4 maybe experts over here, and an estate planning state lawyer firm, 2, 3, 4 people with some paraplanners maybe into these 850 square foot offices and run the family office model. You just benefit so much from an operational efficiency by having them in one place. Okay, off to the right, upper right, the one that is right here, that you can see, this is the entry off of New Hope. one slight jag, and then you're up into our office park. That's our building. It's the anchor position in there, and I'm super excited to not only be in there, but also work with the other businesses that are in there, see if there's any synergies, right? Everything about this is designed for not only operational efficiency, but sense of community. We're going to have some events in here where you can come in and we'll bring experts in that are in private equity. And even if you don't qualify, you can at least hear what it's about, right? Learn more, right? Learn and share. And then in here in the executive lounge, it'll be a fun little area that we can hang out, if nothing else, break some bread, have a drink, and learn more about each other. What I love about the investing industry is all my clients have cool stories, right? So to get together, you're always learning something, learning about different areas. Or I know somebody that, when somebody's like, I need a PI lawyer, it's like, oh, well, somebody in the room is going to know a PI lawyer, right? So really exciting. Had an amazing 2023. You can see kind of upper left. Remember, I was in investment news, got called out of the clear blue for a quote on the S&P downgrade of the United States. And oh no, the world is ending. The S&P says we're not AAA. Okay, well, if you can print money, you don't have to worry about a debt rating, right? That by definition, you just print more and pay it. But anyhow, all the people that listen to the S&P would be, leaving a lot of money on the table. So if you remember, my quote in there is like, if the economy's strong, we're staying long. So there you have it. Got to meet some, here's myself and David and Joel in a conference. Lower left, we have, Allison and I were able to go with meet the governor of Texas up there at the New York Stock Exchange with the president and CEO of Texas Capital Bank. Across the top right, Jeremy Siegel. I got a signed copy of his Stocks for the Long Run 6th edition book. And then you got Bob Pisani, Shut Up and Keep Talking is his latest book. Got to talk to him, signed copy. Bottom right, Michael Kitces, just an amazing mentor for those of us in the field. Gives away almost all of his information for free, widely loved. The lower left there, you can see the person I'm standing there pictured with is Nicole Malachowski, call sign Fifi, fellow fighter pilot. She was the first female Thunderbird. She's on a speaking tour and speaks at a lot of finance events. So just an amazing year. It was topped off. Josh Brown liked my comment today. So a little bit of validation on LinkedIn. He's talking about the Future Proof Conference in September. Where I've never actually shook his hand, but I've been there in the room with him personally a few times. So if you watch anybody on CNBC, listen to Josh Brown. He actually manages money for people like you and me. So he can back it up. He's not just a talking head. He's not always right. Nobody is, but I certainly like what he has to say. Okay. That's it. I went long-winded. Apologies for that, but thanks if you stuck it through. We are going to open up to questions at this time. If you do have questions, put them in the chat. Which I know everybody's shy, and that's okay. But I'll talk for just a second, throw a question in the chat, and we'll get to it real live. Or if not, just remember I'm always available. Reach out to either myself or another member of the team if they're your advisor, and we'll get your questions answered. So to wrap, 2023, great year, 45% growth across the firm, huge up year, in your money, which is what you care about, of growing things. And when I talk about that 45% in 2023 of overall growth, giving referrals to our organization helps generate more revenue, which helps us grow, which brings more experts on board. So you benefit indirectly, right? Because we can grow into this family office model where we have accounting and legal expertise, under the same roof. So it really does help you for you to give us referrals, right? So it's a little self-serving there, but be selfish, right? So yeah, I'll wrap with that. Thank you so much for listening in, and we will catch you guys next time. Bye.